If you're a business owner or real estate investor and you haven't reviewed your tax strategy since the one big beautiful bill was signed into law, you're already behind. Most business owners heard it passed. Almost none of them know what it actually means for their 2026 tax return, and more importantly, what moves they need to make before December 31st to actually lock in real savings. Today, I'm walking you through 4 specific provisions that directly affect high-earning business owners and real estate investors. These are verified 2026 rules, not projections, not speculation, actual provisions, actual numbers, actual math. And if your CPA hasn't called you about this yet, keep watching, because what I'm about to walk you through is time sensitive. Hey there, I'm Tiffany Phillips, CPA and tax strategist. I work with high-earning business owners and real estate investors who are done leaving money on the table. And today's video is one of the most important I've published because the rules just changed and the window to act on them closes December 31st, 2026. Let me start with the biggest one. 100% bonus depreciation is back, and this time it's permanent. Here's a little history because context matters. Under the Tax Cuts and Jobs Act in 2017, we had 100% bonus depreciation. It was powerful. It meant that when a business owner purchased qualifying equipment or property, they could deduct the full cost in the same year it was placed in service, not spread out over 5, 7, or 15 years, all of it year one. But that provision started phasing down after 2022. By the time the one big beautiful bill was being debated, we were already down to 40%. 40 cents on every qualifying dollar. The rest had to be depreciated on the normal schedule. The one big beautiful bill restored it to 100%. And unlike before, there's no phase down schedule. It's permanent for qualifying property placed in service after July 4th, 2025. That means everything you purchase in 2026 that qualifies gets the full deduction right now. But here's where it gets good. This is a non-cash deduction. You're not spending extra money. You're capturing more of what you're already spending in the same year you spend it. That's an acceleration, not a loophole. For real estate investors, when you stack this with cost segregation, the math gets even more powerful. Cost segregation allows you to reclassify portions of your property into shorter depreciation categories. When you combine that reclassification with 100% bonus depreciation, you can turn what would have been decades of deductions into a year one event. Let me give you a real example. Marcus is a business owner who purchased $180,000 in qualifying equipment in 2026. Under the old 40% rule, he would have deducted $72,000 this year. Under the restored 100% rule, he deducts the full $180,000 in 2026. At a 35% effective rate, that's a $37,800 difference. 1 year, one purchase. The window to capture this for your 2026 return closes December 31st. Qualifying purchases need to be placed in service before year end. Now let me talk about Section 179 and how it stacks with bonus depreciation, because this is where most CPAs either get it wrong or leave money on the table. For 2026, the Section 179 maximum deduction is $2,560,000. The phase out begins at $4,090,000 in total qualifying purchases. So for most business owners, you're well below the phase out threshold and the full deduction is available to you. Here's how the stack works. Section 179 goes first. It reduces the depreciable basis of the asset. Then 100% bonus depreciation applies to the remainder. For most business owners, the result's the same, full first-year deduction. But the order matters for how your return is structured, and your tax advisor needs to execute it correctly. Now, let me address the vehicle strategy, because this is where I see the most confusion and the most money left on the table. Most people don't realize that the deductibility of a vehicle is largely determined by its weight. Passenger vehicles, what the IRS classifies as luxury autos, have a first-year deduction cap of $20,200 in 2026. That cap applies regardless of what the vehicle costs. You could purchase a $60,000 car and still only deduct $20,200 in year one. But here's where it gets really interesting. Heavy SUVs between 6,000 and 14,000 pounds gross vehicle weight rating have a Section 179 cap of $32,000, with the remaining basis eligible for 100% bonus depreciation. And vehicles over 14,000 pounds, heavy trucks and full-size vans aren't subject to luxury auto limits at all. They're eligible for the full Section 179 deduction and bonus depreciation on the entire purchase price. Here's what most people miss. They buy the wrong vehicle, structure it the wrong way, and leave tens of thousands in deductions on the table. The weight threshold isn't arbitrary, and it's written directly into the code. A vehicle decision is a tax strategy decision. If you're in the market for a business vehicle in 2026, that conversation needs to happen with your tax advisor before you sign anything. Now, let me talk about the provision that quietly would have cost most business owners a significant amount of money if this bill hadn't passed. The 20% qualified business income deduction under Section 199A. This deduction's been in place since 2017. If you're an S Corp owner, a sole proprietor, or a partner in an LLC taxed as a partnership, you've been able to deduct 20% of your qualified business income off the top before calculating your federal tax liability. On $300,000 of qualified business income, that's a $60,000 deduction. The problem was it was scheduled to expire on December 31st, 2025. Without the One Big Beautiful Bill, business owners were looking at losing that deduction entirely starting in 2026. The bill made it permanent, no expiration, no phase-out cliff. It's now a permanent feature of the tax code. But here's where people mess up. Just because the deduction's permanent doesn't mean everyone gets it the same way. There's a category of businesses the IRS calls specified service trades or businesses: doctors, attorneys, consultants, financial advisors. If your business falls into that category, the QBI deduction begins to phase out above certain income thresholds. For 2026, the phase-out range for SSTBs begins at approximately $203,000 for single filers and $406,000 for married filing jointly. Once you're above those thresholds, the deduction phases out. And above a certain income point, if you're an SSTB, the deduction disappears entirely. If you're not an SSTB, you've got more flexibility, but the entity structure still has to be right. The way you structure your business, how much you pay yourself in W-2 salary versus distributions, and what entity you're operating under, all of that affects how much QBI you actually capture. This is why you don't just do tax strategy, you design it. If you've been treating the QBI deduction as temporary, you've probably been under planning around it. It's permanent now. That changes your entire income structuring conversation. And that conversation needs to happen before year end, not in April. The last provision I want to walk you through affects business owners in high tax states specifically, and it's one of the most significant changes in this bill for that group. Since 2017, the state and local tax deduction, what most people call SALT, has been capped at $10,000. For business owners in California, New York, New Jersey, and Illinois, that cap's been painful. You might be paying $50,000 or $60,000 in state income tax and only getting to deduct $10,000 of it on your federal return. The bill raised that cap to $40,000 for married filing jointly and $20,000 for married filing separately for tax years 2025 through 2029. Let me show you what that means in practice. A business owner in California paying $38,000 in state income tax was previously capped at $10,000 in federal deductions. They can now deduct the full $38,000 at a 37% federal marginal rate. That's a $10,360 reduction in federal taxes from a single change in cap. But here's what you need to understand. This is a temporary expansion. The cap reverts to $10,000 in 2030. That's already written into the law. You've got 2026, 2027, 2028, and 2029 to maximize this window. And it requires active planning, not passive awareness. If you're in a high tax state and you haven't reviewed your estimated tax payments and deduction strategy for 2026 with this new cap in mind, you're very likely overpaying right now. So let me bring this all together. 4 provisions, 4 decisions that need to happen before December 31st, 2026. First, schedule purchases of qualifying equipment or property before year end to capture 100% bonus depreciation. If you've been delaying a business purchase, 2026 is the year to move. Second, review every vehicle decision against the weight thresholds before you buy. The difference between $20,200 and a full deduction is measured in pounds, not intentions. Third, restructure your income distributions to maximize the permanent QBI deduction. If you're currently overpaying yourself in W-2 salary inside an S Corp, you may be reducing your own QBI and losing deductions you're entitled to. Fourth, if you're in a high tax state, verify your SALT position for 2026 and adjust your estimated payments accordingly. The 4-year window's open now. Don't wait until it isn't. The tax code isn't an obstacle, it's a rule book. And if you know how to read it, you can rewrite your financial reality. This bill rewrote several of the most important pages. Make sure your strategy reflects what's actually there. If you want to go deeper on any of these strategies, grab my book, Your Biggest Expense. It's linked in the description. And comment below with the one provision from today's video that you haven't discussed with your CPA yet. I read every comment. Remember, it's not what you make, it's what you keep, so keep more.